right, good afternoon, folks, and thanks,
Hello.
Gerry, for being here.
It's great to be here.
So, by way of introduction, Gerry is the CEO of Clara. He's in the very red-hot expense management space and specifically focused on Latin America. Now, Clara, semi-recently over the summer, raised 80 million, 40 million of that in equity, and the other 40 million from General Catalyst's Customer Value Fund. It is effectively non-dilutive capital. It's debt-like, but not quite debt. Within startups, equity tends to be the primary source of funding. You've raised over your lifetime at Clara nearly 200 million in equity, and so help us understand why in this most recent round did you go half into something that wasn't equity?
Yeah, well, thanks for the question, and it's great to be here. Someone who's coming further away than most. Awesome to see the energy here around building for a better Europe. And I think if Europe does better, the world does better. So it's awesome to be here. And yeah, as you were saying, so we are in the spend management space, focused in Latin America, serving Latin American organizations. We do have a lot of really big European companies that we serve for their LATAM operations. And we're the market leaders in this space. Here you have Pleo, Spendesk, a few others, Ramp in the US. We've raised equity capital, like many others, but we find that for our business and to fund the growth, as we're growing very quickly today, there's other alternatives to fund that growth that can be an asset-backed facility, for example, to fund the post-pay nature of our product, and we work with Goldman Sachs, with some other banks. We have overdraft facilities, shorter term, with our friends at JP Morgan, for example. And as you mentioned, the Customer Value Fund with General Catalyst, who also led our seed round, but now they've created this relatively new vehicle that allows you to fund your S&M without having to take on dilution, and it scales very well with you as a company.
Yeah, so go a little deeper, right? Go a little deeper into exactly what the agreement with General Catalyst was and how that operates. This is a relatively new vehicle for even General Catalyst.
Yeah. So it's not, I think there's like a sense maybe in the industry that like venture debt can have some downside. So it's like very much not that, right? And like avoiding the trappings of having a kind of capital that can be like very inflexible and like not aligned with equity investors. Here it's equity, it's capital that's very explicitly very well aligned with investors, so much so that it's one of our major shareholders, the leads of our first round, our seed round, who are behind it. And the way that it works is that it's non-dilutive capital that is specifically targeting your S&M budget, and they will pre-fund essentially a quarter's worth of S&M spend so that you go out, acquire customers, and then you pay back from a share of the revenue that you start generating over time from those customers. It has some nice qualities that make it very flexible. And in the case that the cohort were not to perform, actually as a company, you're not on the hook ultimately for it, right? So there's no way in which this, unlike venture debt, can affect your company, like potentially bankrupt it, create kind of those scenarios, maybe nightmarish scenarios that are out there. So it is non-dilutive capital that ends up being very well aligned to the company's growth.
Have you ever been approached about venture debt? And then why did you not take it, right? What were those nightmare scenarios? What were those features that made them unattractive to your company?
Yeah, so we have, and we've seen terms for that as well. I think that the downsides is that it kind of ends up being perhaps like at a different extreme from equity capital, where equity capital is about funding a longer-term vision and perhaps like less certain outcomes, whereas a debt investor is typically looking for extreme certainty, right? Like they want to make sure that they get paid, they know their exact return. And so what that means in the context of working with a startup is that there might be a lot of restrictions placed on that company.
For example, right?
Yeah, like sticking like very closely to a kind of operating plan and certain KPIs. Keeping cash reserves, but generally like all forms of covenants, which can look very different from one company to the next. And then there's a downside that if those covenants are not met, then those investors might be very incented to just make sure that they get their money back, even at the expense of the company or like the equity holders. And so that makes it very different to having capital that's just like for a specific purpose, well aligned, and it is bankruptcy remote, so like it can't affect the company fundamentally.
Yeah. So talk about a little bit more about that. Let's go back to the customer value fund now. The customer value funding that you got in particular. So my understanding of it also is that it is generally more useful, and General Catalyst uses it generally for customers and businesses that have recurring revenue and/or customers that are very, very sticky.
Yeah, that's right. So you need to have recurring revenue that is sufficiently predictable and good margins, and that's what they're looking for, and also a minimum scale, right? So it doesn't necessarily work for every company, but it does work for companies that are kind of at our stage, getting into or past the 9 figures in annualized revenue. You want to keep growing, accelerate on growth. So you do need to meet kind of these minimum criteria, but once you do, it is capital that can scale very well with you. So our facility started at $40 million, as you mentioned. But they've announced facilities now as large as $1 billion with Grammarly/Superhuman now.
Right. Yeah, like it can grow. And then, so also tell me, right, like you guys are doing a lot of payments, which is not always predictable. Yeah. So then for them, for General Catalyst, what was the repeatability? What was the stickiness within your business?
What was it?
What was the stickiness, the repeatability that they were seeing within Clara?
That they saw in our business?
Yeah.
I mean, we have today like a very efficient growth engine overall, right? I mean, we've been perfecting it, since early days. We have a growth motion that is product-led at its core. But then we've layered on, a sales team, sales component, also a very AI-empowered sales team. And so, we're growing very efficiently, having paybacks, within about 6 months on a contribution basis for the customers that we're acquiring. And so, it made sense to pour more into that fire, right? But basically, that's what they saw, right? That we had this efficient acquisition with good CAC paybacks because of the margins today, and also we had sufficient scale today and potential in the future that it made sense to start partnering earlier this year.
Okay, so tell me more also, because you mentioned a whole host of other sources of funding that Clara has. Aside from what you have from General Catalyst, you also have securitizations. You've also got warehouse lines. How do you think about the mix as you're stacking all of them together and you're adding on new ones with different return profiles on top of it? How are you thinking about what gets used for what purpose, and then at the same time, when you start tapping into another, you get a new source of funding?
Yeah. So ultimately, as many companies, we want to grow as fast as possible and invest as much in product and our innovation as possible, while also, being efficient with our capital, taking on, the least dilution that we can possibly for our team, for our earlier investors. And so, what that mix looks like is that we've raised equity capital. For us, that's our balance sheet, and that is what we use to invest in. We think of it as in our product and engineering, bets that are longer term, and half of our payroll or more is directly investing in the product, so our engineering and design function. But then there's other things in our business like growth that we were covering. That there's these new capital options that allow us to invest in that while not having to use the equity, which means that we wouldn't be able to invest as much in our product, we wouldn't have as much of a strong balance sheet, and do it in a non-dilutive way. Or, as in our case, because we have a post-pay nature to our product, our customers can use the credit line effectively that they have with us, make payments on their cards or bill pay, cross-border transfers, and not have to pay us back until after the end of the cycle. So instead of having to use the equity money for that, we have these asset-backed facilities. We started working with Goldman Sachs 3.5 years ago. There's some other partners in the mix that we'll be announcing as well. And that means that, again, we don't have to use our equity capital for that. The business that could nominally be cash demanding actually becomes quite cash and equity efficient.
Yeah.
Almost to the point that, because of the dynamics in our market, we're able to have a negative working capital cycle.
So, what's the benefit in that case, right? You have all these different pieces, all these different sources of funding, different partners. Capital seems relatively abundant depending on the financing style. What's the point of equity now to you?
What's the point of equity? Well, I mean, I think if you can raise equity from good partners at really high valuations that are giving you, a lot of credit for where you're going to be in the future. I think that's always a strong option. Like if you're our friends at Ramp, raising, I think a few $100 million casually every few months, like absolutely, Eric, like, go at it. But I think the reality for most is that you have to like balance, between taking on more capital and considering like what that does to your dilution. So, I think we have experienced as a company ourselves kind of like a full cycle in the ecosystem, and perhaps in Latin America even more pronounced, higher beta than elsewhere in the world.
2022 and 2023 was fintech winter for sure. Yeah.
For sure. We're like in 21 we could have raised also like around every month, right, as offers were coming in. Things got a lot quieter, and now we've built a much more robust, much more efficient business that now it feels like the next wave as it's coming, we're like in the best position to ride it. But if the equity capital comes at the right terms, I think you should raise it, but then be thoughtful about how you use it.
Yeah, it's part of this for you, right? Having all this availability of credit facilities and also securitizations and these debt-like non-dilutive instruments. Is part of it where we are in the credit cycle, the macro environment? I'm thinking like the U.S. is not everything, but the economy of the U.S., the Fed rates that they do have a tendency to ripple out throughout the economies of the world. The Fed rate has, it has fluctuated and it continues fluctuating, and none of us know where the heck it's going. But it's no longer zero, and that makes a big difference. We're starting to see at the same time private credit players jumping in. You're seeing the banks becoming competitive as well, and they're lowering some of their rates in response to the private credit players. And so how much does that impact what's going on for you?
The interest rate environment, you mean generally?
And the availability of private credit in general.
Yeah, like many things in Latin America, it was more pronounced, right? And like if interest rates went up a bit in the US or here in Europe, they went up by even more in Latin America, which means also like credit at competitive terms also became less available. So for us, we've ended up seeing it as a competitive advantage, right? I think in most contexts, it's probably naive to say like capital is a moat. But I think in a more capital-constrained environment, as Latin America is, I think like having access to funding and like the right kinds of funding, I think as we've been able to put together, is actually a competitive advantage to the point that we had most of our direct competitors on the fintech side like fade away over the last 2-3 years.
And become like, I'm guessing, either acquisition targets or
Yeah.
So within do you now have to go for so LATAM, right? You've seen some of the funding struggles there. Is the U.S. still where you go for the most capital at this point?
For funding overall, no, we have quite a mix. We have some of the best regional VCs involved, like Monashis and Kasek, probably the two most renowned VCs in the region. And then we work a lot with folks from around the world, really, like a lot in the U.S., in Europe too. Like the DST global partners who are here at the event. Picus Capital, a few others. And even for some of these banking partners like Goldman or JPM, they actually have local operations in each of these countries. So we think of them as global banks, but we actually end up working with their local operation.
Yeah, and then how do you think about negotiating terms with them on this warehouse line side?
Yeah, the reasoning, right, for a lot of these funds ends up being quite different, right? So you have to shift from the mentality or the mode of pitching the dream and how big you're going to get and all the efficiency towards that to pitching much more what the debt investor cares about, which is the certainty and what is the risk-adjusted return that I'm going to get here. We pitch to that, and we serve corporates, and we have very good performance in the business and stability, so that helps. And as we've evolved as a business over the past 3-4 years working with these kinds of partners, our terms have tended to get a lot better. So I think that's something that's important to know, that pretty quickly, if you find the right partners who have that capability and you're presenting kind of the right data, your terms can get a lot more competitive quickly.
Yeah, as you work with them more, do you take terms to each of them and say, hey, I have this competitive sheet. Can you do me any better?
Yes. But yeah, most recently, we had a situation where we had multiple bidders, several of the largest global banks and like domestic banks like bidding for the same facility, and like that naturally helped get much better terms. I think that's always going to be the case. You know, there's a degree of FOMO everywhere.
Yeah. So the other part I have to then ask about, right, is as we're talking about these multiple kinds of financing facilities, it gets a lot more complex. And it is one of the reasons why I think some startup founders, especially in the earlier stages, are a little bit more nervous to get around it. You hear tons of stories even on the more basic levels of funding where, right, folks get to the sale of their company and they're not really sure how much of the company they're actually selling. They don't know what the full company's ownership percentages look like. So as you're managing these higher levels of complexity, different levels of returns for all these different investors involved, different kinds of risk, how are you thinking about managing that, right? How are you thinking about communicating to new investors, hey, this is what the returns might look like this is what the company looks like today?
Yeah. I mean, I think it's still like largely the same, right? Where it's like, you know, there's an equity investment, a company is like going to grow, you know, this many times over within this time frame. This is how we're going to do it. But then also, like on top of that, be able to communicate, hey, like we've been very thoughtful about our capital stack, so that the equity funding that you're putting in is actually, going in like the most efficient way towards that mission. You know, by investing in, in the product and these longer-term bets. And not in things that as we were discussing in these circumstances, you can find other sources of like non-dilutive capital. So actually, when you think about your adjusted for dilution returns, from here to IPO and beyond, we are a much more efficient business because of everything that we've put together. And then, there's no reason to be concerned because each one of these facilities has like a very specific, like dedicated use. Like, right, with like General Catalyst and the CVF, it's funding our S&M. We could fund that with equity, but it's not as efficient as from an equity perspective as using the facility. The worst thing that could happen is that we stop using the facility and we have the option to do that. But it's not going to affect the company in any way beyond just that.
Do you think folks should be getting a CFO earlier in their company's life? Do you guys have a CFO?
Yes. So we have a finance function, and I'd say it's not necessarily a very large one, but I think it is a very effective one, and key part of the business.
Yeah, and do you think folks, like in general, folks should be getting CFOs across the startup stage? And I ask this in the sense that, like, I think not everyone necessarily. Like, do you think that most startups need? Do you think this level, this amount of financing, right? These number of different kinds of financings, is suitable for all startups?
Yeah, I mean, I think if you're gonna go for an approach of having a more sophisticated capital stack, like for sure, someone who's more senior, who's kind of seen that, in our case, the leader of our finance function, Travis, has been on the investor side, is also a banker, and so he's seen, multiple kinds of funding, and even though he was, most of his career had been in VC. So yeah, I mean, I think, and it's beyond that, very strategic function, right? Like ultimately, like we are serving CFOs, we're serving controllers, finance teams. I think it's a function that has some of the most important decision making in the company. It's like how to use your resources, make the best use of them. There's a lot of innovation happening in this space. We're very happy to be spearheading that within the Latin American context. We see ourselves also as like the way that the finance function in LATAM is deploying AI for finance. So I think having the right leaders with the right strategic mindset around this is key more than ever in the world today.
Yeah. Do you think that there are certain kinds of financing that are missing that you would like to see more of?
I mean, I think we have like several different parts to our capital market stack as we've been talking, right? So it's just not just equity, but asset-backed, CVF or S&M, short-term liquidity facilities, standby letters of credit, etc. I think more than kind of more of a mix, I think it's key to think like how does more of this become available to companies at an earlier stage? Like for us, even like some of these things only became available as we reached a certain scale. We are actually talking to some of the partners that we work with about how we can be a partner, connecting these capital solutions to our own customer base. So I think that's what we're excited about as well. I think it's more like access to a broader set of companies to these solutions than something different from what already exists.
Yeah, so it makes me wonder, right? I've seen like different kinds of financing for startups. Because this sounds like what you're talking about, right? Different kinds of financing that are like venture debt-like, non-dilutive, but they're not quite debt. And you either maybe get some equity or they're a little bit more creative structures than that. Some of those companies have not always like lived up to their promise in recent years. What's different now, or what's different about what you guys are thinking about?
That's a good question. I think you do have to find businesses that are already at a sufficient maturity in several ways, like including in the unit economics for the model to make sense. But I think where we can come in as a partner is in helping like bring down the cost of servicing so that it makes sense to do for younger companies, even if, but they do have to have kind of the right foundational strength for it to make sense, right? You're not going to do revenue-based financing for a company that is selling $1 at 80 cents, because then that's going to eventually blow up, right?
Yeah. Yeah, it does feel like, do you feel like there's an opportunity given the number of AI, like what this all looks like with the number of AI companies that are out there? The profile is interesting, right? Because there's, these models are growing so massively quickly. Some of them are highly repeatable, but then at the same time, the risk is someone else spins up another company of the similar sort, odd lovable, right? And then becomes a competitor and takes away some revenue from them.
Yeah. And in some of those cases, right, like some of these AI companies, like maybe they're not a fit for this kind of capital yet, like unless like their profit, like their gross profit margin is already there, right?
Yeah.
I think that's why like equity is probably like they're going to be the main source of funding. But if you do have a product where like the margins are proven, the growth motion is proven, then you might have other alternatives.
Right, and to be clear, you're not anti-venture debt. Like you still think there's an opportunity, there's a place for venture debt in this ecosystem.
Well, I think like venture debt as traditionally thought of, as we were talking about earlier, it can be dangerous if it's very constraining for the company, if it comes with all these covenants. But when it's structured in the right way, because it's meant like for a specific use and it's bankruptcy remote, then it is a great tool. I think it's not your mother's venture debt, right?
It's not your mother's venture debt. Well, what is your idea of what is not your mother's venture debt?
Yeah, precisely, the kind of capital that is misaligned with equity investors, right? And I think there's like a new set of, non-dilutive capital that is aligned with equity investors and the company more broadly.
Yeah. Final question for you, really. As you're thinking about equity, as you're thinking about the current funding ecosystem, equity, like, fintech is back, right? And like the broader venture economy is going, like funding is rising again. Does that make alternative sources of funding less popular as equity becomes more bountiful again?
Possibly. But it depends very much on the ecosystem, right? And I think there's always going to be a place for equity and a place for alternatives, and kind of depends on the relative cost of capital of each, right? Like, if we were in 21 or like ramp today, where we're getting all this capital like well ahead, kind of
heavily
of your metrics, and like take that. And I think we are, in fintech inclusive, like more in a place where things are in a more balanced place. I think things like really cooled down for fintech for some time now. I think it's the right time to like start raising equity again. But any companies that have a much more efficient capital stack, I think as what we've built over the past 3-4 years are in a much better position to do so, because every equity dollar just like goes much further, now and kind of forever.
Yeah. Takeaway is like take that banker's call, even if it feels like it's too early. Is what I'm hearing.
Yeah.
Awesome. Thank you so much, Gerry, and thank you all for joining us today. Enjoy the rest of your slush.
Thank you all.
I think we're heading.